How Indian share market works. The Indian share market, also known as the stock market, works as a platform for companies to raise capital by issuing and selling stocks to investors. Investors can buy these stocks, which represent ownership in the company, in the hope that the company will perform well and the value of their shares will increase, allowing them to sell their shares for a profit. There are two major stock exchanges in India, the Bombay Stock Exchange, BSE, and the National Stock Exchange, NSE, where shares of publicly traded companies are bought and sold. The BSE is the oldest stock exchange in Asia, while the NSE is the largest in India in terms of market capitalization. The stock market operates on the principle of supply and demand. When there is more demand for a particular stock, its price goes up, and when there is more supply, its price goes down. The price of a stock is determined by a number of factors, including the company's financial performance, economic conditions, global events, and investor sentiment. The stock market in India is regulated by the Securities and Exchange Board of India, SEBI, which ensures that companies comply with disclosure and other regulations to protect investors' interests. Investors can participate in the Indian share market through various means, including direct investment in individual stocks, mutual funds, and exchange-traded funds, ETFs. It's important for investors to do their research and understand the risks and potential rewards of investing in the stock market before making any investment decisions. The Indian stock market is a financial market where shares of companies are bought and sold. It is one of the largest stock markets in the world, with a market capitalization of over $25 trillion. The Indian stock market is divided into two segments, the primary market and the secondary market. The primary market is where companies raise money by selling shares to the public for the first time. This is done through an initial public offering, IPO. Once a company has listed its shares on the stock exchange, they can be traded in the secondary market. The secondary market is where investors buy and sell shares of already listed companies. This is done through stockbrokers who act as intermediaries between buyers and sellers. The price of a share is determined by the forces of supply and demand. When more people want to buy a share than sell it, the price goes up. When more people want to sell a share than buy it, the price goes down. The Indian stock market is regulated by the Securities and Exchange Board of India, SEBI. SEBI is responsible for ensuring that the stock market is fair and transparent. It does this by setting rules and regulations for companies and stockbrokers. The Indian stock market is a complex and dynamic market. It can be a great way to make money, but it is also a risky investment. It is important to do your research before investing in the stock market. Here are some of the key features of the Indian stock market. It is one of the largest stock markets in the world. The price of a share is determined by the forces of supply and demand. If you are interested in investing in the Indian stock market, there are a few things you need to do. Open a Demat account and a trading account with a stockbroker. Do your research on the companies you want to invest in. Only invest money that you can afford to lose. Be patient and don't panic sell if the market goes down. The Indian stock market can be a great way to make money, but it is important to do your research and understand the risks involved before investing. Thanks for watching.